Good evening to our viewers in Korea and hello to others watching from around the world. Welcome to Within the Frame. I'm Han Da-eun in Seoul. The U.S. Central Bank has kept its key interest rate steady, keeping it at a 23-year high for the sixth straight time. This while consumer inflation in Korea eased slightly, dipping to the 2% range for the first time in 3 months. Amid lingering global uncertainties, the Japanese yen dropped to a 34-year low, heating talk of intervention. For an in-depth analysis on the latest economic headlines and future projections, we're now joined by Yang Jun-sok, economics professor at Catholic University of Korea, in the studio. It's always a pleasure to have you on our show.
Happy to be here.
Also with us tonight is Hwa-gyun, professor of banking and finance at Mays Business School of Texas A&M University. So great to have you with us.
Thank you for the invite.
All right, let's kick things off at the U.S. Fed. Dr. Yang, so it was a rate freeze as widely expected. What factors led to the Fed's latest decision?
Well, the biggest factor was that inflation still remains high, and the Fed is not convinced that the inflation is definitely on its way back to their 2% goal. Now, looking at their preferred measure of inflation, the Personal Consumption Expenditure Index, for March, the inflation over 12 months was 2.7%. That's slightly higher than where it was in February, and the core inflation was 2.8%. That's the same as it was in February. If you look at the 1 month inflation, almost the same thing. It's at 0.3%, both for the headline and for the core, and that hasn't changed in 2 or 3 months, depending on which measure you use. And the job market is still strong. It's in March, the U.S. created 303,000 jobs. That's higher than expected, even though that's maybe down to the pre-pandemic levels. If we had those same numbers during the pre-pandemic, it would have been a very good market indicator. So the Fed is not convinced that the inflation is going back down to 2.0% anytime soon. And so they're determined to see that the interest rate remains higher for longer and try to make it, give it more time to work to try to reduce inflation so that they can be convinced that it's on its way back to 2.0%.
So the Fed's decision was influenced mostly by inflation that still remains sticky and also partly by strong U.S. jobs data as well. Now, Professor Kim, Fed Chair Jerome Powell said that inflation remains sticky but showed optimism that the price growth will likely resume cooling this year, but he avoided offering a timeline for rate cuts. How would you interpret his comments?
I think it's mainly driven by uncertainty still the Fed is facing with. Yet it's very calculated move typically when the Fed chairman is talking about this type of thing. So the cautious optimism means that at least some advanced data or their analysis probably show that some improvement is likely in the future, but they don't want to take a strong stance because it can be risky in terms of effects on the financial markets and also the global markets. So having said that, if we just put this type of in terms of some perspective, as just Professor Yang mentioned, the core inflation, the measure is around 2.7% according to this new release. And the real GDP growth was around 1.6% at annual pace for the recent quarter. So if you sum them up, which is about 4.3%, this is a rough measure of the stable, the real interest rate for the 1 year, the horizon. So compared to the target of about 5.25 to 5.5%, clearly it's higher. So as you can see, the monetary policy stance is pretty tightening still. And that I think is probably working, although it's kind of slow. In fact, actually, we recently have one bank actually also having bankruptcy. So clearly this higher real debt burden is constraining the economy to some extent, which helps cooling down the economy. But at the same time, of course, it can actually affect negatively on the economic side. So overall, I think the strong job market and also the strong overall economic sector prevents the inflation from going down the faster. But I think the overall the Mr. Powell's statement is saying that probably some cautious optimism. So probably for the next in a quarter or two, I think we will start seeing some more the positive nuances about the rate cuts.
Well, Fed Chair Powell did say that inflation will likely cool towards the end of the year, but he still kept everyone guessing about the timing of a rate cut. So we're expected to see U.S. rates continue to stay at a 23-year high, at least for the time being. And Dr. Yang, how would the U.S. Fed's higher for longer interest rate impact the global markets and the economy?
Okay, well, the problem is the U.S. economy is probably the only major economy that's doing really well right now. The IMF did revise their global growth estimate upwards, but if you look at the country-by-country numbers, U.S. estimate was revised upward a lot. The BRICS countries, Brazil, Russia, India, and China, they rose somewhat moderately, but for almost all other countries, it remained the same or it fell. So the the longer duration that we'll have for longer, higher interest rate from the United States is probably not going to help these economies which are very sluggish. So we are seeing some economies like Switzerland and Mexico who are unilaterally dropping their interest rate because their economy cannot stand it anymore. But for the rest of the countries, I think they'll try to stick with the higher rates as long as possible. They're much more integrated into global economy. But I think toward the end of the year, we'll see more and more countries perhaps dropping the rates earlier than the United States because their economies just may not be able to stand it for that longer. Right now, the largest attention is now being paid to Japan because they might not be able to weather the longer high interest rate that much.
As you alluded to, Professor Yang, one of the currencies that's suffering the most steep depreciation right now is the Japanese yen. Dr. Kim, the Japanese yen broke the 160 mark this week, the first time in 34 years. It came down slightly on what's widely believed to be a government intervention, but analysts say the super low yen will likely continue. What's causing the record low depreciation, and where would the yen go from here?
So the probably short answer is probably the migration of investors from the Japanese yen to the US dollar because of the sharp interest rate differentials between the US and Japan. Both US dollar and the Japanese yen are pretty safe assets in terms of like among these currencies. Therefore, the investors love to hold these both of assets as they're safe haven in some sense, but then the interest differential has been really high. The difference, of course, compared to like 10 years ago, for instance, is because this difference actually has been maintained for at least like a few years, is that the Japan didn't really move the target for the time being, but then now the inflation starts picking up, so the Japan starts increasing the interest rates. But despite that, the investors start realizing that the Bank of Japan is pretty reluctant to increase the targets, while the U.S. target still is going to maintain high for the time being. So I think this interest gap is going to be pretty substantial. So this investor starts just moving back to the dollars, and therefore there's just basically the selling yen, and that actually makes the price really low. So even if the Bank of Japan is going to just intervene as before, I don't think this is going to be major enough so that investors actually will be afraid actually, or just they're scared actually not to do it. So for the time being, this tendency is going to be maintained, and there's a chance that it can go even higher to like 100, 170 or something. Eventually, it's probably going back a bit, but I think for the time being, we will see this the high the deterioration rate actually for the time being maintained.
So the dollar strength will continue, and the yen will continue to plummet against the greenback, despite some signs of government intervention. In related question, Professor Kim, how would the super low yen affect the Korean $1 exchange rate?
Yeah, I think we get this type of questions like against Japanese yen, against the Chinese yuan. So I think it's about the similar story because because of the industry structure of South Korea. So because the South Korean won and the Japanese yen are also co-moving a lot. So at this stage, if the investors view South Korean won and the Japanese yen as in the same type of basket, then I think you will kind of sell together. If that's the case, then we will see the similar weakening US to Korean dollar, actually the exchange rate for the time being. Having said that, of course, if the Japanese yen is weaker, then South Korea tends to import more than export from to Japan. Therefore, this should actually help, in terms of the currencies, the accounts of the South Korea. So in the medium term, I would say about 2 to 4 quarters. I think that things will probably help a bit so that it'll bounce back in terms of like the South Korean the won. But for the time being, it is not going to be very positive news to Korean won as well.
All right, Professor Yang, meanwhile, South Korea's consumer inflation eased to 2.9% in April, falling below the 3% range for the first time in 3 months. What factors led to the decrease, albeit marginal? And are we now seeing the much awaited start of a downward trend?
Well, in some ways, the Korean inflation was always on a downward trend. It's just that fruits and vegetables really distorted the numbers. If you look at the core inflation, just the excluding fruits, vegetables, and oil, then the core inflation has been falling nicely for the last 5 or 6 months. Core inflation for April was 2.3%. That's very close to the Bank of Korea's 2.0% goal. And if you look at the monthly headline inflation, that was 0.0%, so it didn't change during the last month. Core inflation did rise a little bit, 0.1% in March to 0.2% in April, but that's still within annual 2.0% range, so that's not too bad. The inflation rate for industry goods over the industrial goods for the last 12 months was only 2.2%. For services, again, for 12 months, it was only 2.2%, so we're almost back to normality in those fronts. But the fresh food inflation for 12 months, 19.1%. For just 1 month, though, just for April, we have a slightly good news. It fell, minus 3.7%. So fresh food is still expensive, but it's not as expensive as it was last month, sorry. So if this trend continues, then we might see continual reduction of inflation rates. As I said, if you exclude food and energy, you're very close to Bank of Korea's goal of 2.0%. But the problem is the prices for food and energy right now is basically unpredictable. Food, because of the strange weather that we've been having for the last couple of years, and oil because of the global political situation.
You mentioned that core inflation has been falling here in Korea, but that certainly wasn't felt by the public because of the soaring prices of fruits and vegetables. And looks like we're going to need a fresh approach to bring down the prices of agricultural products. Now, in the meantime, Dr. Yang, the government has put gas rate hikes on hold as part of efforts to ease inflationary pressure. What other government policies or measures do we need at this point to further stabilize prices?
Okay, well, the problem with monetary policy is really it's a very blunt tool. You're lowering interest rates, so you're trying to build up, or if you raise interest rates, you're trying to reduce overall demand. But the problem right now is specifically in food and energy. So policies targeted at food and energy will be probably a better way to try to control prices here. The government has reduced tariffs for a lot of fruits. The only problem is the fruits that they've lowered the tariffs for are fruits which are not produced in Korea. The government says that this is for safety measures, but Some of these approvals for imports of apples, it's taking 8 years. So I have some doubts on whether this is really a safety problem. But still, you want measures to specifically try to bring down the prices of fruits and vegetables and energy, which are the core problems here. And the problem is, there's not that good a ways to reduce food prices. That's partially the reason why we don't count food prices in core inflation. It really depends on things like weather, and we're probably going to have more strange weather this year, partially because of global warming. And as I said, oil prices right now are unpredictable because we don't know what Israel and Iran will do. So the government has a really tough time. In some ways, the monetary policy is working. We see that through core inflation. But the way that people look at inflation, they look at the products that they buy most often, and I'm sorry to say that's fruits, vegetables, and gasoline. So even though situation is probably getting better, there's no way that people can really feel it until this current problem with fruits and vegetables end.
So it'll be extremely difficult, but measures will have to focus on taming the prices of food and energy. Now, Professor Kim, South Korea's GDP ranking fell behind Mexico last year, sliding to 14th place in the rankings. This is the lowest in 11 years. What are the underlying factors of the fall, and what are their implications?
Well, as we just talked about the exchange rates, the Korean exchange rate has been pretty deteriorated. So clearly that's the big reason. And comparatively speaking, I think the Mexican peso has been quite stable, or actually it's been strengthening against dollar for the time being. So that's obviously a very mechanical reason why we see this type of, the things. And if we look at a bit more details of the economic, the data, then the last year, it's been pretty tough for the South Korea in terms of exports, as we know, and also the growth rate has been slow. While in case of Mexico, in part because of the U.S.-China, the trade tensions, and also the U.S. policy of we have to have everything now within this, the continent type of thing. So because of this, this nearshoring trend has been pretty popular. So I think there were a lot of investment from China and some other countries to Mexico. So that's one of the reasons why the Mexican economy has been booming a bit last year. And that also contributed a bit to the exchange rates. And therefore, we see this type of the things. But of course, what South Korea needs to worry more about is the long-term trend. If this is just temporary things that affects the exchange rate versus, as we just keep talking about, the low growth trend of the South Korea because of the fertility rate and other types of things, or the regulations. If that's the case, then I think the South Korea needs to change this overall trend using some reform or some other types of things, or through innovations and things like that. So if this is just a temporary thing, I don't think the South Korea needs to worry too much about it, because probably it's going to get improved. But if this is more coming from this fundamental weakness that the South Korea is kind of facing with, then yeah, probably we have to think more seriously about it.
Well, the Bank of Korea Governor Lee Chang-yong has said that Korea's growth rate will rise to 2% if we make structural reforms. So it looks like we need to swiftly work on reform measures to prevent the country's growth rate from slipping further down. Well, we'll leave our discussions there tonight. Thank you so much, Professor Kim and Professor Yang, for sharing your insights and breaking down the numbers for us. And that brings us to the end of the show. Thank you for watching, and be sure to tune in same time tomorrow to join our conversation. Goodbye for now.